Hello everyone, welcome to Anu's classroom. So early on in this course of MMPC 3, while we were talking about the Indian financial system, we discussed about the circular flow of income, output and employment between the household and business sectors. I hope you guys did go through that video. In case not, I would strongly suggest you guys go and take a look at it because that was also an important topic. So, financial institutions like banks and insurance companies play a very important role in the channelizing of savings into investments. And understanding the importance of this sector, IGNO has dedicated a whole unit to discuss about the major banking sector reforms that were introduced as part of this new economic policy of 1991. And then also about the recent reforms also we should be able to have, or we should have a knowledge which was introduced in the financial sector, especially post 2010 also. So this session in our MMPC 3 course is modeled from Unit 9 of MMPC 3, which talks about the financial as well as fiscal sector reforms that have taken place in our country. So in this session, we will be reviewing the major reforms that were introduced in the financial as well as fiscal sector during as well as after 1991. We will also discuss the reforms in banking and insurance sectors as well as tax reforms that were introduced in India in the recent times. So in 1991, the government of India set up the Narasimham Committee to examine all aspects that are related to the structure, functioning, organization, and procedure of financial systems to remodel these institutions for raising their overall efficiency. The committee, after studying the sector, gave the following recommendations. So the committee recommended that we must eliminate government interest rate controls as they were not at all profitable. The committee also highlighted that the interest rates should be determined based on market forces and not by the government, which was the case earlier. Committee recommended that we should reduce the SLR and CRR from 38.5% to 25% and CRR from 15% to 3 to 5%. They recommended the reduction in the number of public sector banks and suggested that mergers and acquisitions will increase the bank's efficiency. The committee recommended setting up an ARF or Asset Reconstruction Fund to take over those portions of bad and doubtful debts from banks and financial institutions. And the committee proposed RBI to be the sole primary banking regulator in India. To improve the workings of the banks, the committee, that is Narasimham Committee, we are talking about the first Narasimham Committee here, okay? The committee recommended that every bank be free and autonomous to carry out its work. Over regulation or over administration should be avoided, and the selection of chief executive as well as board of directors should be made solely on merit. These recommendations were from the first Narasimham Committee. In 1998, the committee was again tasked with reviewing the progress of banking sector reforms and design a program to further strengthen the financial structure, technological upgradation, human resource development, capital adequacy norms, and bank mergers. And this came to be known as the second Narasimham Committee or Narasimham Committee 2. And this committee made the recommendations like merging the major public sector banks to boost the trade, RBI to be made the regulator, but at the same time, they should not have ownership in any bank. And the committee proposed the government should increase the capital adequacy ratio norms and foreign exchange open position limits to carry 100% risk weight. And minimum startup capital for foreign banks should be increased from 20 to 25 million from 10 million. High non-performing assets or NPAs were definitely a problem back in 1998. So committee recommended in narrowing the banking concept where the banks could put their funds in short-term risk-free assets. And the recommendations all led to the securitization as well as reconstruction of financial assets and enforcement of Security Interest Act. Securitization and reconstruction of financial assets and enforcement of Security Interest Act in 2002. Setting up of small local banks which would cater to needs of the state or cluster of district to serve local trade, small industry and agriculture were all recommendations from this Narasimham Committee too. Banks were also recommended to give more autonomy and freedom in the recruitment of skilled specialized manpower from the market itself. Rapid introduction of computerization and technology were recommended, and they also proposed amendments in the Banking Regulation Act, Nationalization Act, and State Bank of India Act, RBI Act, Bank Nationalization Act, etc., to allow for a greater economy, higher private sector shareholdings, and so on. And a few of the reforms that were made by the government of India to strengthen and stabilize the financial sector include the government of India in 2010 created the apex body, which is non-statutory, to promote the financial sector and development and strengthen the mechanism for maintaining financial stability, called as the Financial Stability and Development Control, FSDC. The Union Finance Minister is the chairperson of this FSDC, and other members include the Governor of RBI, Chairman of SEBI, IRDA, and others. Then we have the Forward Market Commission, FMC, which was established in 1953 and acted as the regulatory body for commodity futures market in India. But as part of the financial sector reforms, this FMC got merged with the Securities Exchange Board of India, SEBI, in 2015. This merger was aimed at realizing the benefits of economies of scope and scale for exchange and to harmonize the regulation of commodity derivatives and the securities market. Then, before the Insolvency and Bankruptcy Code of 2016, there were several laws and procedures, mostly overlapping and adjudicating forums, which dealt with the insolvency and financial failure of individuals and companies in India. I am really sorry for the background noise. There is construction work going on near my house, and I have absolutely no way of avoiding it. So that is why you're hearing it. Apologies. Anyway, coming back to our our topic in mind. We were talking about the what was happening before the Insolvency and Bankruptcy Code of 2016. So the institutional and legal framework imposed a very heavy strain on the Indian credit system because there was no time limit on the effective and time recovery or restructuring of defaulted assets. So the new code, Insolvency and Bankruptcy Code of 2016, aimed at consolidating and amending the laws relating to the reorganization and resolution of corporate persons, individuals, and partnership firms in a time-bound manner, as well as how to deal with sick industries and everything. One of the biggest problems in the Indian banking system pertained to the non-performing assets or NPAs. So to deal with that problem of stressed assets and all, Banking Regulation Amendment Ordinance of 2017 was promulgated in 2017. The ordinance enabled RBI to deal with these non-performing assets quickly. And to find a solution to this deteriorating condition of corporate banks in the country, government amended the Banking Regulation Act of 1949 and enacted the Banking Regulation Amendment Bill of 2020. And the major objective was to bring these cooperative banks under the supervision of RBI. To provide a universal social security system, especially to the underprivileged and the poor population of our country, three major schemes were launched in 2015. Pradhan Mantri Suraksha Bima Yojana, Atal Pension Yojana, Pradhan Mantri Jeevan Jyoti Bima Yojana, and along with this, we will also look at the Ayushman Bharat scheme. So, Pradhan Mantri Suraksha Bima Yojana scheme provided the coverage of Rs 2 lakhs for accidental death and permanent total disability and Rs 1 lakh for partial disability. This renewal of 1 year accidental death disability cover is available to account holders in the age group of 18 to 70 years. The premium of just 12 rupees per annum is deducted from the bank account through the auto debit facility in one installment. Then we had the Pradhan Mantri Jeevan Jyoti Bima Yojana, which is a scheme which offers renewable 1 year term life cover of 2 lakh rupees to all the subscribing bank account holders. The subscribers can be in the age group of 18 to 15 years. This is offered also by the Life Insurance Corporation LIC and all the other life insurers as well. A premium of just rupees 330 rupees per annum is auto debited in one installment from the subscriber's bank account. The Atal Pension Yojana was introduced in 2015 to provide pension, especially to people engaged in unorganized sectors like gardeners, maids, and all. This Atal Pension Yojana replaces the previous Swavalamban Yojana, and this scheme provides a defined pension depending upon the contribution as well as the contribution period. Coming to the Ayushman Bharat scheme, which was launched on the recommendation of the National Health Policy 2017 in order to achieve universal health coverage. This is a scheme which has two interrelated components, that is Health and Wellness Center and Pradhan Mantri Arogya Yojana, Jan Arogya Yojana. Health and wellness centers were developed to cater to primary healthcare need of the citizens in their respective areas. A large number of services related to reproductive, maternal, newborn, communicable disease, ENT, ophthalmology, and others are provided in these centers, so that people need not run to any nearby town or city, ultimately leading to saving both time, energy, and money. Pradhan Mantri Jan Arogya Yojana was launched in 2018, which is the largest public health insurance scheme in the world itself, and it aims to provide Swasthya Suraksha to nearly 10.74 crore poor people, vulnerable families, as per the socio-economic caste census of 2011. The beneficiaries of Rashtriya Swasthya Bima Yojana, that is, the scheme provides a cover of 5 lakh rupees per family per year for medical and hospitalization expenses in most of the secondary and tertiary hospitals. 3 days of pre hospitalization, 15 days of post hospitalization expenses are covered under this, and all the pre existing diseases are covered from day 1 onwards. So, these are some of the reforms in the insurance sector that has come about. Now, coming to the reforms in the tax sector. So, we will first look at what happened in 1991. So, coming to the government initiatives in improving the direct and indirect taxation system of our country, many committees have been appointed to suggest measures. We will discuss about three that are mentioned in our course: Chelaya Committee, Kelkar Committee, and direct tax reforms. So, to examine the structure of both direct as well as indirect taxes, a tax reform committee under the chairmanship of Dr. Raja J. Chelaya was constituted in 1991, and the main task of this committee was to give suggestion on the ways to improve the elasticity of direct and indirect taxes, making the taxation system, you can say, broad based and fair. Most of the suggestions made by the committee were incorporated at the time in the budget of 1993 to 1994 as well. In 2002, again, a tax force under the chairman of Dr. Vijay Kelkar was constituted to recommend measures for simplification and rationalization of direct and indirect taxes. This came to be known as the Kelkar Committee. The committee recommended formulating a simple and effective and better tax system. Again, in 2012, under the chairman of Dr. Vijay Kelkar itself, another committee was formulated to outline a roadmap for fiscal consolidation. And the main reason behind constituting this committee was that in 2012 to 13 period, the fiscal deficit was at a soaring high, estimated to reach 6.1% of GDP. At a higher fiscal deficit is a cause of worry for our economy because it could lead to higher inflation as well. The external balance could widen, investment growth and employment tend to weaken, and the overall confidence of investors will also be shaken in such cases. So, the direct taxes are those taxes which are the impact and incidence of the tax fall on the same person, like income tax, corporation tax, etc. A series of reforms have been introduced in the direct taxes also, like the Taxation Laws Amendment Ordinance of 2019, Finance Act of 2020 and all, to encourage the digital transactions and reduce these unaccounted transactions. Now, the major thing when we come talk about tax reforms, we cannot ignore GST, right? Goods and Services Tax. One tax, one market, one nation. Correct? The Indian Constitution gives the power both to the state and central government to levy taxes. Central government, they levy taxes like customs duty, central sales tax, etc. Whereas state governments can levy taxes like value added tax. Now, if you remember, a few years back, we had to pay a wide variety of taxes at various levels to both the center as well as state government. And our tax structure was also quite complex. It even had a tax on tax. Now, this set of multiple taxes with all these different tax bases and tax rates are all so costly to administer as well as comply with also. So, what happened? We decided to have just one comprehensive indirect tax or consumption based tax, which is called as the Goods and Services Tax. This concept of GST was actually introduced in the year 2000, but it came into effect by the 101st Amendment to Constitution of India from July 2017. The motto of Goods and Services Tax is one tax, one market, one nation. With the implementation of GST, what happened is large number of indirect taxes were all subsumed into just one. GST is applicable on the supply of goods or services as against manufacture of goods or on sale of goods or provision of services. So what you can say is it is a destination based consumption tax. There is a GST is also of two types. We have the central GST and state GST. Central GST or CGST is what is levied by the central government. SGST, that is state GST, is levied by the state government. Integrated GST or IGST is levied on interstate supply of goods or services. It is levied and collected by the central government and is divided among the union and states on the recommendation of the GST Council. At present, we have four rates of GST: 5%, 12%, 18%, and 28%. And few items like alcohol for human consumption and all are exempted from GST altogether. Similarly, petrol, high speed diesel, supply of petroleum crude, natural gas, aviation turbine fuel, electricity, and all are also kept outside of GST. GST Council is an apex committee on GST matters, and the chairman of this GST Council is the Union Finance Minister, along with one member from each state, and so on. This GSTN is a non-profit, non-government organization which manages the entire information and technology system of our GST portal. Taxpayers can file their tax returns through this GSTN portal, and the government can track every financial transaction through this GSTN. Some of the benefits of having GST are, first and foremost, definitely creation of a unified common national market for India and boosting this Make in India campaign, eliminating multiple taxes, mitigating the cascading of taxes, as well as harmonization of laws and rates of taxes, evolution of simple tax regime, increase in ease of doing business, reduction in the price of goods, and in the long run, benefit to customers as well. So those are a few of the things that were discussed in our unit 9 of MMPC 3. As we conclude this session, once again, I'm reminding you, this is a unit from block 3. Block 3 only has two units, unit 8 and unit 9, and we can expect at least one question from both these units. So no matter what, do not, I repeat, do not at any cost, do not skip either of these units. Okay, both 8 as well as 9. There is an appendix given along with unit 9, which I suggest you should go through while preparing for the term and examination also. I hope this session and this whole course on MMPC 3 is providing useful to you in the preparation for your examinations. Until I see you in the next session, thank you so much for tuning into Anu's classroom. Take care. Bye-bye.